Welcome back. I'm Michael Bull, and this is the Commercial Real Estate Show. Today we're talking about the office market 2017. My guest is Walter Page with CoStar. And Walter, let's talk about cap rates. So it seems like the investment sales market's been pretty hot. What do you see for cap rate trends in 2016?
In 2016, we saw totally flat cap rates, at least according to our data. For the institutional quality properties, we're seeing cap rates around 5.7%, virtually unchanged over the past year. And we're seeing 7% on average cap rates for the median of the market, which I would call the Class B type property. And that, again, was relatively unchanged over the past year.
Yeah, that's interesting. And so why do you think they're not changing?
Why is it flat? I think the growth prospects as we go forward is diminishing, as we expect lower rent growth in a lot of markets than what they've had in the past. The other expectation is that we're going to have rising interest rates, and we've since the election had a spike in interest rates, and I think that was somewhat anticipated by the marketplace.
And what do you expect moving forward for interest rate increases?
So interest rates. Well, the 10-year Treasury went up by almost 100 basis points since the election, so that's a huge thing. But what we've seen is a flattening of the forward futures curve. Today, the 10-year Treasury is between 2.5 and 2.6. We expect the 10-year Treasury to hit the 3% level sometime in late 2018. So that's only 40 basis points over the next 2 years, which really is not a huge increase in interest rates. So basically, fairly level playing field on that aspect.
Well, that's interesting, and I think a lot of investors in commercial real estate would like hearing that. So what do you expect moving forward for cap rates then in the office market for the next year or two?
Okay, so because you have a rise in interest rates, you are likely to get some rise in cap rates. But we think that the pass-through rate of the increase in interest rates is going to be relatively small. So we're forecasting on a nationwide basis between a 20 and 30 basis point increase in cap rates over the next 2 years. That would equate, if you didn't have any change in your NOI, that would equate at a 5.7, 5.8 cap rate today, that would equate to about a 5% drop in value. Most likely at that same time you would have NOI growth that would offset that and basically result in relatively stable property values.
Right, and that's banking on interest rate increases to be pretty low, really.
Yes.
Yeah. So if Trump's presidency creates an opportunity for some inflation or some growth, and the Fed decides to bump up those a little faster, then I guess the jury's out?
Well, then the pass-through rate is going to increase because if it's over and above what is expected in the marketplace, then we would expect there would be more pass-through, probably 50 or 60% of whatever above the expected increase was in interest rates.
Okay. And what do you expect for demand moving forward for office investment properties, Walter? It seems like the U.S. is still considered a safe place to invest in real estate, and I think a lot of people feel pretty comfortable with the office sector in general.
Okay, so let's just recap what happened in 2016 first. So in 2016, we saw a 9% decline in office sales on a nationwide basis. This is part of a broader thing of where we saw 11% decline in the overall U.S. real estate market sales volumes. But you got to take that in perspective because 2015 was the top year for all real estate sales in the industry as a whole ever. Now, for office, it wasn't the highest ever, but it was the second highest ever. So that's that. Now, going forward, we got two factors in play here. One, rising interest rates will suppress sales. But we also have increased foreign demand for U.S. real estate. And I was recently reading an article from JLL, and they're saying that increased foreign demand is going to be a key driver of demand for office and general real estate in the U.S. Going forward.
Yeah, I'd agree with that. And typically it seems like foreign investors are interested in the major gateway markets, but they're also showing some interest in secondary markets, aren't they?
We've seen over the past year, the decline in sales volume was really concentrated in markets that people perceived as having some risk. So Houston sales volumes were off 50%. San Francisco had some sales volumes that were off in the neighborhood of about 30%, and New York also. And part of that is those markets have had a lot of construction. In contrast, a lot of second-tier and smaller markets have had increases in sales volumes, principally because they don't have a lot of construction, and the perceived risk from some of those markets is not that high.
Right. And before you have to leave us, Walter, can you leave us with a tip for an investor or an operator in the office sector?
Well, a general tip is that we are seeing a leveling of the playing field between CBD and suburban markets. So, and we expect that leveling of playing field in terms of total returns will carry forward in the future. So, you can look in all ports and probably find a reasonable deal.
Right. Well, very good tip. And as usual, great information. Walter, thanks for being with us.
Thank you.
If you'd like more information from Walter, visit CoStar.com and stay with us. We'll have more on the U.S. office market for 2017. I'm Michael Bull. This is the Commercial Real Estate Show. Stay with us. Hey there, thanks for checking out the Commercial Real Estate Show. Don't miss a video of special interest to you. Be sure to subscribe below. And if you appreciate the videos, be sure and thank our sponsors. There's a link to more information about them in the description. For more videos, podcasts, and articles, check out CREshow.com.